This is why you shouldn't be trading meme stocks like GameStop, AMC, and Nokia unless. Okay, so you've been hearing all about the revolution of meme stocks run by Reddit, and that's killing the hedge funds and putting on a huge David and Goliath show right now, and it's all over the news. Tons of people have been profiting and making the news. They say they've been buying GameStop at $18 and selling it for $400. The quick explanation for this happening is that these stocks have been short extendedly by these hedge funds, and all of a sudden these huge amounts of retail traders are buying buying call options for these names, and so they're forcing the hedge funds to cover their positions and to buy up the stock at whatever price it is now. And full disclosure, I myself missed the run up too. Yes, I do have a little bit of FOMO because this is a huge opportunity and huge gain, but I'm kind of glad I didn't participate because the main reason for me is that I've seen many of these run ups go parabolic for a few days and then they kind of just fade back into obscurity. And for me, this is what GameStop is doing is an anomaly. And this is not the norm. Stocks don't run up 2,000% in 2 weeks' time. Yes, sure, you can say that maybe I'm just bitter because I missed the run, but I believe that as a professional trader, it's more important to be consistent than to participate in something that you're not familiar with patterns that just aren't there, and with hype that can ruin many retail traders. So let's look at retail traders versus institutions and big money. Retail is just you and me using our eyeballs to look at charts, flip through them, and look at different time frames like what I'm doing right now, and maybe going through 2 to 3 charts every minute. While as institutions have multi-million-dollar systems and professional algos that go and buy and sell in milliseconds. And right now it looks like that, in the battle of David versus Goliath, is that David, the retail traders are winning, but Goliath has more than enough tools to destroy David. And they've been doing that for years and decades. And they're going to be quick enough to adapt and adjust to these new information as well. And you have to think about, for every one trader that makes the news that says that they bought here at, $18, $20, and sold up here at $400, there are hundreds, if not thousands of traders that probably bought around this range here at $300, $400, and they're holding the stock and hoping for it to run up to 1,000. And it's a much bigger chance that it's not gonna hold, and it's likely to fade back down to maybe, if you're lucky, $80 to $90. If you take a look at AMC and Nook and Express, a lot of these names are already happening. You look at AMC, it started at $2. Sure, it's holding up at $13, but let's look at Nook. Started up at $4, ended up at $4. You look at Express. Started at $1, ended up at $5, which is still holding its gains. But look at BlackBerry. Started at $12, ending up at around $14 right now. So a lot of these names are just going to run up and they're going to fade. And you have to think about that fundamentally, these names were not the hottest to start with. Why were they overshorted by these institutions? You think about, is GameStop without any innovation gonna survive in the long run with all these online streaming game services like Stream and other platforms? You think that AMC Theaters is gonna make a comeback after the pandemic and everyone's gonna flock to the theaters? Do you think that people will want Blackberries or Nokia phones still when there's huge names like Samsung and Apple products? We have to know that big money have influence that you wouldn't even imagine. It's easy for them to spread misinformation and get ahead of all the retail traders because a lot of the times they already know what interests retailers are interested in. What stocks are they buying ahead of time? And it's easy for companies themselves, like AMC, who recently did it, to just dilute their shares and do share offering to devalue their stock prices and to just keep afloat. And it's easy for brokers like Robinhood, which you've heard a lot about, to just limit the shares that you can buy just to protect themselves and other big players. Know that the big institutions have been moving markets and stocks for years. And I'm not saying that retailers don't have the power to do anything, but with the power of retailers, we've been moving one, maybe two stocks that have triggered such a huge event. But think of what the institutions have been doing for years and decades. And in my opinion, is that the way to make money as a trader is to anticipate what the big boys are doing. And the market is not truly free, and those are the rules that we have to play within. I did say not to play these charts unless, and let me tell you about the unless. Because as a technical analyst, when I look at the chart for GME, there were a handful of opportunities to make confident trades. If you take a look here on January 22nd, what happened was that there was a strong bull volume, it ran up, and it held the 1 hour EMA. It was consolidating, and it pushed right back up near the end of day. So, with that, I can anticipate it was likely to gap up the next day, which it did. So that was one anticipated good play that you could have made. Another one was this move. There was a push up here, and it consolidated into a bull flag. So that was another bullish sign that it could go another leg up, even though this was very extended at this point. And it did. It opened up right up here, almost at $500. And the last move here was this here. This was triggered by Robinhood limiting shares of people purchasing GameStop. So it caused a huge drop. It came down here, and we had an oversold bounce opportunity. But even this wasn't very clear because there was no clear support of where this move would have gone. And if we look over here, there was really no clear Fibonacci or anything that really gave it a good indicator of where this bounce would start from. So this could have just kept going down, and you could have kept adding positions and averaging down, but it could keep going lower and lower. So it was more of a high risk play. And so anyway you look at it, this chart, if you look even on the daily time frame at GameSpot, this confuses me because it doesn't give me the proper information I need to make good risk to reward plays. Sure, I can guess and wish that it'll go up forever, but then that's just gambling. I mean, how many professional poker players go all in with a pair of twos, hoping that the other two twos will show up on the flop or on the river for a four of kind? I mean, who does that? And what are the chances of that happening? Stocks like this, there's tons of hype and tons of news, both positive and negative. So how do you plan to decipher all of that? And what do you choose to believe? So that's why I believe that you shouldn't play these meme stocks unless you use a small position according to the risk level and tolerance that you're willing to take. So you have a set percentage loss. You use technical analysis with strong emphasis on volume and just try to avoid news as much as possible. As I said, there were a couple plays that were based on volume in this chart. And just for these names, play short term. Flip in and get out quickly. Because if you take a look at Nokia, started at $4, went up to $9 within 3 days, and faded right back to $4. BlackBerry, same thing. Within 4 days, it faded back into the normal price where it was. So flip in, flip out quickly. Don't bag hold. Don't hold and hope that it's going to go up to $1,000 on GameStop there, because that's likely not going to happen. And let me know in the comments below if you agree or disagree with what I've said. Let me know if you made a crap ton of money on GME or any of these meme stocks lately. I just want to know what you guys are doing and how it's been for you guys. So leave a comment below, make sure you hit the like, subscribe to my channel, and we'll see you guys next time.